Apple has dropped its Q2 2026 results, and the word of the day is dominant. We are looking at a record-breaking $111.2 billion quarter that has analysts calling for a beat and raise status. Here's a visual teardown of these massive numbers to see why the market is reacting so strongly. To understand this monster quarter, we're following a four-step analytical flow. We'll start with the headline beat on the top line and EPS, move into the specific segment drivers and margins, evaluate the quality of the cash flow, and finish with the final risk versus reward verdict. Let's talk about the headline numbers. Apple hit $111.18 billion in revenue, a 17% increase year over year and a record for a March quarter. Diluted EPS came in at $2.01, surging 22%. This massive growth was sparked by a full-blown iPhone 17 supercycle and all-time high engagement across their services. The flow-through to the bottom line is incredibly strong. While revenue grew 17%, operating income jumped even higher at 21% to reach $35.88 billion. GAAP net income hit $29.75 billion, but notice that EPS growth actually outpaced net income growth. That is a direct result of Apple's aggressive share retirements. Apple's margin engine is firing on all cylinders. Consolidated gross margin stretched to 49.3%, up 220 basis points from last year. This was driven by a high-margin hardware mix from the iPhone 17 Pro and a massive services margin that hit an all-time high of 76.7%. Breaking down the segments, the iPhone is the star, bringing in $57 billion with a 22% jump as demand shifts toward the expensive Pro models. Services added another $31 billion, up 16%. We also saw growth in Mac at $8.4 billion following the MacBook Neo launch, and iPad at $6.9 billion, thanks to the new M4-powered iPad Air. The big geographic surprise: the China rebound is officially real. Revenue in Greater China hit $20.5 billion, a 28% surge year over year. This represents significant market share gains in the region. Meanwhile, the Americas grew 12%, and Europe saw a 15% increase. Apple is spending big to stay ahead in AI. Operating expenses hit $18.8 billion, a 24% increase. The real story is the R&D surge, up 34%, as the company pours capital into AI integration and the underlying infrastructure needed to power it. When it comes to cash, Apple remains the gold standard. In just 6 months, they generated over $82.6 billion in cash from operations. After accounting for $4.3 billion in capex, they are left with a staggering $78.29 billion in free cash flow. Their total liquidity now sits at $146.6 billion.
Management is putting that cash to work with a historic capital allocation plan. They've authorized a brand new $100 billion share buyback program, which creates a massive floor for the stock's valuation. They also hiked the quarterly dividend by 4% to 27 cents per share. This wasn't just a big quarter, it was a high-quality one. Stock-based compensation only grew 9%, which is much slower than revenue growth, meaning limited dilution for shareholders. Plus, cash from operations is leading net income, proving these earnings are backed by actual cash rather than accounting tricks. Every investment has two sides. The bull case is built on the AI hardware refresh and the massive recurring revenue from the services ecosystem. The bear case? Persistent regulatory scrutiny from the US DOJ and EU, alongside intensifying costs for advanced semiconductors and memory.
The synthesis here is that Apple has become the ultimate flight-to-quality asset. Despite the regulatory headlines, it provides an unparalleled safety floor because of its expanding margins, geopolitical resilience in China, and those unmatched $100 billion capital returns. To recap the quarter, a 17% top-line surge driven by the iPhone 17 supercycle, margins stretching to nearly 50%, and an EPS jump of 22%. With a $78 billion free cash flow war chest, Apple has cemented its status as a safe haven for investors. So, what's your play on Apple? Does that $100 billion buyback make it a screaming buy for you, or is the regulatory risk too high to ignore? Drop your thesis in the comments below. If you found this Apple earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.